Howdy friends, Steve DePoe here for the Rose Realty team with this week's real estate vlog. Today we're going to talk about the 4.5 credit myths that first-time homebuyers have. Let's get right into it. This is some good stuff. Hey, look, actually the Rose Realty team works a lot with first-time homebuyers, and there's a lot of bad info and a lot of myths out there. I think one of my first vlogs, maybe a year ago, was all about myths and stuff that first-time homebuyers have about financing, etc. I think I did another one a couple months ago. But there's a lot of bad info floating around out there that first-time homebuyers have that they absorb. This sort of ain't true, and so we want to kind of help dispel some of those rumors and those myths. Hey, look, maybe this isn't for you. Maybe you're sitting there, you're not a first-time homebuyer, and you've got, you're on your fifth house or whatever. Feel free to forward this to anybody you know that could be a first-time homebuyer. Your son, your daughter, nephews, grandkids, whatever. This maybe could help them in that home buying, the whole home buying process. Let's start talking about it. So closing an old account can help my credit. Yep, no, it's not going to help. When the credit bureaus calculate your credit score and your history, they look at how long they look at how long bank accounts have been open. So if you have one, let's say that you opened when you were in high school or college, that's kind of sitting there with maybe a couple of $100 in it, maybe not a lot of activity. Hey, that's helping you the most because it's your longest serving account, and it's going to help you the most. They're going to say, hey, look, Steve has had an account out there I've had his accounts out there for X number of years, average them all together. And that long run, the one that's been out there the longest that you want to close, that's helping you the most right now. So don't close out any sort of bank accounts that maybe you're not using right now. Let's just keep them open. It helps your credit history. All debt is treated equally. Nope, not so much. So here's the deal. Your short-term credit, your revolving credit, like your credit cards, those are the most risky, and those are hurting you the most. If you've got a high amount of debt on these revolving credit cards, that's hurting you the most. It's not the same, for example, like as a car loan, for example. A car loan is a longer-term debt that's actually helping you if you're paying it off on time. The revolving credit and credit cards, it's actually hurting you, and here's why. Because if you've got long-term, so they're going to look at the history again. And if you've got some long-term debt out there, revolving debt out there, a lot of revolving debt out there, they're thinking you're just using the credit cards willy-nilly, right? And they feel that you can go out and buy a stereo system, for a couple of grand, every other week or every week, where it's not likely that you're going to go out and buy a new car every week, right? So the car is actually helping you, even though you maybe owe more on it, or maybe more on a monthly basis than your revolving credit. And so you've got to pay off the revolving credit as quickly as you can, not sacrificing, of course, savings. Okay, so that's something to think about. Number three, credit repair companies can help me improve my credit. Yeah, no. Okay, so here's the dirty secret about them. What a credit repair company is going to do is come up with a plan. Okay, they're going to say you got to pay off all of these things on time. You've got to pay these minimal amounts, on your car and your credit cards and your rent and all those kinds of things, right? And let's say, for example, at the end of the month, after you've paid off all these things, you had a couple of trips to McDonald's and Domino's and those kinds of things. And let's say at the end of the month, you have $400 left over. What this credit repair company is going to do is they're going to say, okay, take $100 and put it to this credit card, $100 to this one, and $100 to this one, and take $100 and put it in savings. That's the credit repair plan that they're going to come up with, right? No, you can do that on your own. Everybody's got access to a computer, right? Come up with a spreadsheet, list all your accounts, list where your money's going to go, and at the end of the month, when you've got that spare money, figure out where you're going to put it off to pay down some of these debts. Okay, you don't need a credit repair service to help you out with that. You can frankly do it on your own. Okay, paying off a collection or a debt or an old debt removes it from my credit history. False. So any derogatory marks on your credit history are going to stay there for 7 years. 7 years. Think about that, okay? 7 years. So it's not like I paid off the bad debt or I finally paid off that loan or something like that. Now it's gone. No, it sticks around for 7 years. So your credit history and your credit score are some of the things you should be protecting the most in your life. Okay, those are the things you should be working on from sort of day one, trying to make them better. And they're not going to just go away if you paid off that bad loan or you paid off that credit card, unless it was improperly reported by the credit card or the loan company, or it was identity theft. If it was either one of those things, if it was identity theft, you're gonna have to show a history of trying to fix that, right? Again, and also if it was incorrectly reported, you're gonna have to talk to, like, let's say, that credit card company and say, hey, look, I paid this off, and here's the check, here's the check that I can get to show you that I paid it off. If that's the case, then that credit card company will talk to the credit bureaus and they'll say, look, we messed up. Steve paid it off. Take this off of his credit history. Now, they won't take it off actually, but they'll have a note there that says, hey, Steve paid this off and American Express falsely reported it. That's what's going to happen here, right? So if it can be explained away, do it. You got to actually, here's something interesting. If you take a look at the credit reports, there's something like 10% of the stuff on all credit reports are wrong. Okay, so it's all a bunch of numbers and account numbers and all that kind of stuff, but 10% of the stuff on credit histories and credit reports are wrong. So it's good on maybe a twice a year basis to go back and check out your credit reports and make sure that everything on there is correct. Okay, so there's another hint, and that's number 4.2. Okay, number 4.5, that relationship status or divorces can reflect on your credit history. Nope. Wrong again. So if you had a divorce someplace in your past, it doesn't reflect on your credit history unless you had a joint bank account, for example, and one of you was bouncing checks left and right, or had joint credit cards, that type of thing, and was charging up large amounts of credits. The financial aspect of your relationship will show up on your credit report. I actually worked with a couple of years ago, who they got divorced. He got divorced, and he ended up remarrying. But his ex-father-in-law was like so ticked off at him, he was charging up stuff on his credit card and making him look bad. And so he had to, number one, cancel that credit card. Number one, that was the most important thing to do. And number two, he had to explain to the credit bureau, hey, here's what's going on. Now, he was a stand-up guy and paid off that stuff, but it made him look bad that it was out his limit in terms of credit. So he fixed it, but sometimes it ain't easy. Okay, so the fact that you were divorced or you're married to Jane Doe or whatever, it's not going to reflect poorly on your credit history. It's the financial aspect of what that relationship was like, which could reflect negatively or positively on your credit history. So there's 4.5 things, myths about credit and credit history for first-time home buyers when you're thinking about getting a mortgage and buying that first house. We've worked a lot with first-time home buyers. We've seen it all. I mean, believe me, we've seen it all. We've seen too much. It keeps me up at night. But we've seen it all. And so if you have any questions, whether you're in the Metroplex or not, give us a call. We can kind of point you in the right direction, and we can kind of try to help you out. Next week, several weeks ago, we talked about why to use an agent if you're selling your house. It was for sale by owner versus real estate agent versus using a real estate agent. Next Friday, we're going to talk about why use an agent at all. Now, this has to do not only with selling a house, but buying a house. And a lot of it is protection for you. Okay. One of the things we do as agents is we protect from a fiduciary. Look it up. It's a fiduciary responsibility for either the seller we're working with or the buyer that we're working with. And that's held out primary above all. Okay. So kind of an interesting fact. A lot of people don't know that. They think we're just in it for the money, blah, blah, blah. But actually, you know what? We have a fiduciary responsibility. And if you have an agent right now that's not taking that fiduciary responsibility correctly, you better find another agent. I mean, please. find another agent, because they're just making us all look bad. So next week, why use an agent at all? This is Steve DePoe for the Rose Realty team. I'm going to bounce.